From oil tankers in the Strait of Hormuz to slowing U.S. GDP growth and questions about consumer spending, markets have a lot to digest today. Welcome back to Navellier Market Buzz. Secured passage for 23 oil tankers through the Strait of Hormuz. Is that a sign that tensions might be easing?
It's a sign that Iran needs money. India controls 40% of the shipping through the Strait of Hormuz. They want 23 oil tankers to go through. France and Italy are also reaching out to Tehran to get their tankers through. So this blockade really hurts them economically. And obviously they're going to have to rebuild because of what's happening. It's still very fluid, but that's why oil prices start to calm down a bit and the market's firmed up.
So now the U.S. fourth quarter GDP was revised down to just 0.7%. What drove such a sharp downgrade?
It was the government layoffs, we had the federal government shutdown, and we had the big jump in the trade deficit in November and December. Fortunately, though, in January, the trade deficit fell 25% due to booming gold exports. So that bodes well for all those gold stocks we own. So the first quarter GDP growth is going to be a lot better. The trade has an incredible impact on GDP. And also in February, we're clearly exporting a lot of natural gas at a high price because it got cold in Europe and here. And then we're exporting crude oil and refined products. I'm expecting the trade to really help boost first quarter GDP. We won't get to that 5%, but first quarter is going to be a lot better. In fact, the Atlanta Fed just revised it up to 2.7%. So that's a good sign.
So consumer spending also slowed in that report. Are the American consumers starting to pull back?
Well, they're fickle. There's no doubt that consumers are fickle, and they're not really spending money on durable goods. They're spending money on comfort things, bars and restaurants and things like that. I think it's just a weather thing. I mean, I'm here with you in New York. You told me it was 70, and I got here, it was snowing. And obviously, spring is right around the corner. The daffodils and tulips will be popping up, and everybody get out and about and spend. The weather has a big impact, and it is holding back first quarter GDP, but as we get into April, the second quarter GDP is going to be much, much better.
And Canada lost nearly 84,000 jobs in February, and unemployment rose to 6.7%. Is the economy starting to stall?
That's a big number for Canada. And in January, they lost 25,000 jobs. And apparently it's a lot of the youth in Canada. So Canada is definitely headed into a recession. And that's going to be Prime Minister Carney's problem. I'm sure he's going to blame Trump for the issues. I know they're mad at Stellantis, the big automotive company, because they're hurting. They had to do a lot of cutbacks, and Canada took a lot of those hits, and that's going to affect Ontario. So that just means the Bank of Canada is going to be cutting rates to stimulate their economy, but that's our neighbor, and that's a lot of job losses for them. They're just a tenth the size of America. That's like us losing a million jobs this year. So yeah, it's going to put downward pressure on interest rates, and they're just one of many central banks that will be continuing to cut rates and doing quantitative easing.
Now let's preview some earnings. Let's start out with Alibaba, China's e-commerce giant. Are the consumers finally getting back into shopping mode?
No, they're not happy in China. The deflation has been rampant for almost 4 years, since May of 2022. They want to postpone their purchases. They're not buying big ticket items. Their EVs sales in China are very poor. Alibaba's sales are forecasted to be at 4.2%. Their earnings are forecasted to decline 48.9%. And we do have analyst cuts pretty severe in the last 90 days. My other comment about Alibaba, it has missed the last 3 quarters. So I have bought Chinese internet retailers in the past. The last one I bought was VipShop Holding, that's VIPS. I'm not recommending that, just so you know. But Alibaba has never hit my model, never fit it. And of course, their founder now lives in Japan because he had some issues with it. He was criticizing the leadership in China, so now he lives in Japan. So I wish them well. but it's not looking good.
Next up, Alarum Technologies, a smaller cybersecurity and data firm. Is this one of those under-the-radar tech names that could surprise investors?
It's definitely under the radar, and I've recommended this stock in the past. I'm not recommending it now, but they do have explosive sales growth. They have beaten analyst estimates for the last 4 quarters, but their earnings have been a little bit too erratic, and that's why I'm not in it right now. Just so you know, their sales are forecasted to be at 52.9%. Their earnings are forecasted to decline 90%, though. That's the problem. But they are surprising, big time. Their smallest surprise is 249%. Okay, so this is a wild card. This is the problem with small cap, is the analysts just can't get a handle on this. As soon as it has earnings, I'll be all over it, but it says their earnings are going to drop. I'm not in it.
Jabil reports next week, the company that quietly builds electronics for many of the world's biggest brands. What does it tell us about the tech supply chain?
Well, this company's business is steadily growing. They have beaten the last 4 quarters. Their sales are supposed to be up 15.2%. Earnings supposed to be up 28.5%. And we do have positive analyst revisions. And it has, again, a good surprise history. So this is a circuit board company. It's not quite as spectacular as my other stocks as far as sales and earnings growth, but it is definitely being lifted by the entire tech sector.
And then we hear from Micron, a key player in memory chips and AI hardware. Is the AI chip boom still going strong?
Absolutely. Micron makes memory devices. They're investing a lot of money. NVIDIA's having a conference next week that's going to help all the storage companies, the optical companies. Just so you know, Micron sales are forecasted to be up 37.4%. Their earnings are forecast to be up 451.4%. We have very, very strong analyst revisions, more than double in the last 90 days, and huge earnings surprises. It was 20.7% last quarter. This stock is recommended in our newsletters. The stock is under management and must go higher, because we own it.
Williams-Sonoma reports as well, high-end home goods for people who apparently have $300 to spend on an air fryer. How is the upscale consumer holding up?
Not good. Their sales are supposed to be down 2.2%. Earnings supposed to be down 11.5%. The analyst estimates are steady, though, and it does have a good surprise history. But if you look at its revenue, it's dropped off quite dramatically in the last 4 quarters. Yeah, this is a luxury item. And this is just, people just don't have the disposable income right now to buy all these wonderful things at Williams-Sonoma. Nice store, though.
I actually went there the other day to try and find cupcake liners, and that's the one thing that they don't sell.
They will when they charge a lot for it.
Yeah.
Yeah. They only sell expensive stuff.
Yeah, not the small stuff. Lululemon is also on deck, premium yoga wear with very premium margins. Is the athleisure trend still running strong?
Kind of. Lulu, well, let's just go over their sales. Their sales are supposed to be down 0.8%. The earnings are supposed to be down 22.1%. We do have some analyst trims, but it does have a pretty good surprise history. And last quarter, it did surprise by 16.9%. So they're all about guidance, okay? And the other thing about Lulu is they sell a lot of men's clothes, okay, that women buy for them. So this stock's going to be all about guidance. That surprise last quarter got everybody's attention, so let's just see if they can keep that up.
Next is Dollar Tree, where the name hasn't quite matched the prices lately. How is the budget-conscious shopper doing?
Not good at all. Sales are supposed to be down 33.9%. That's a big one. Earnings are supposed to be up, though, 10.5%. No estimate changes from the analyst community, and it does have a good surprise history. Last quarter was 11.8%. So it's pretty hard to have your earnings improve when your sales are declining. So we'll see if they can pull this one off, okay? But it's not strong enough for me. If they surprise, guide higher, I take it all back.
Darden Restaurants also reports, the parent of Olive Garden. Are people still going out for the unlimited breadsticks?
I don't think so. They have other franchises, And we actually, when you went to school, there was a guy I met that designs the restaurants and all the themes. But their sales are supposed to be up 5.6%. Their earnings are supposed to be up 5.3%. The analyst committees held their estimates steady for the last couple of months. They did not surprise in the last 2 quarters. This is comfort food, the most expensive restaurants out there, high volume ones. So we'll see if things cheer up. I'm a little worried the weather might have held them back too, because the severe winter we had in the Northeast might have impeded them just a tad. We'll see what happens. Okay. but they're going to have to start surprising because they've missed the last two.
FedEx is also reporting, often seen as a bellwether for global trade. What will shipping demand tell us about the economy?
Yeah, FedEx had a pretty good surprise last quarter. Their sales are supposed to be up 5.9, earnings are supposed to be down 9.2, and the analysts have trimmed their estimates a bit, although the last 2 months they started rising back up. So they're all over the place. But last quarter, they had a 17.2% surprise. So FedEx is going to have to guide higher. Now, obviously, the aviation fuel is very sensitive to what's going on in the Middle East right now. So is the cost of diesel. So that could start to impact their bottom line and then curtail their guidance. But they always give good guidance. I mean, they just always tell the truth is what I'm trying to say. So whether it's good, bad, or ugly, they'll tell us. And I think the stock will react to it. But they have been doing better.
And finally, Carnival, cruise ships, buffets, and a vacation demand. Are travelers still eager to set sail?
Well, yeah, I recommend Royal Caribbean RCL, but this one, their sales are supposed to be at 5.6 for Carnival. Earnings are supposed to be up 39.8. That's all those extras they charge you on the Carnival boat. And no analyst changes. And last quarter, it had a 38.6% surprise. So this stock has had massive surprises in the past 4 quarters. So I suspect it'll do okay. The only thing that can impede them is, the cost for the diesel for the boat. Yeah, I think this one will be okay. I'm not recommending it. It's not in my portfolios. I like RCL a little better, but it's a good group.
Perfect. Well, thank you so much for joining us this Sunday. We hope you enjoyed today's video. If you have any questions that you want us to answer in Wednesday's midweek update, please leave them in the comments below. But until then, we'll see you all for a new video.